Know what that means. I had to make sure I got front door. Or front section. Yeah. Did you get these? I had an XL. Oh, we were like, I mean, it's kind of bad day. It was great. Like, I'm just small. In plus Greenville make shirts, they'll be like 3X. There's like larges I'll get. I just want to sleep and use it.
All right, how's everybody doing?
Great.
Tired,
No reason.
great, tired. Wow, that sounds not good. The nap part sounds great.
Yeah, it was great. I was like, what?
I've had a really weird day today. So this morning, my husband called me and told me that the city called him and that our house had a leak. And we had leaked 100 gallons of water in the last 24 hours. No, not a gas leak, a water leak. And so I go to our house and we have a bathroom upstairs that our kids use. And right now our kids are with their mom. And so no one has used it in the last 2 weeks. And the toilet had just been running the whole time. So thankfully it wasn't, worse than 100 gallons. But that was fun to figure out this morning. So then I got in my car and now I also have a tire that's leaking on my car. So
Me too.
lots of weird leaks today.
I've got a tire. So I got to wait for another week.
Yeah, I gotta go get mine fixed today.
It's starting to get weird.
There's a place in town that does it, that fixes them right off the square. All right, when I call your name, let me know you're here, please. Ashley, Sarah, Julia, Noah, Dylan, Othon, Tobias, Julian, Dwayne, Taylor, Lawrence, Thomas, Kyle, Cole, Tony, Emma, Evan, Malik, Trent. Hey guys, if I'm talking, please don't. Thank you. Lucas, Jalen, Chesley, Colton, Haven, Daryl, Jefferson, Justin, Gage. All right. Mark all of you guys is here and save that. Before we get started, a couple things we need to talk about. First, if you feel like you need some extra credit in this class, I have an opportunity for you. Briner is hosting his first annual Briner Game Night at the Smart Center with all of your favorite Briner School of Business professors on Thursday, November 11th at 6:30. There will be free food and drinks and games. I don't know exactly what games, but there's going to be like a bunch of different tables set up. Each of the professors is leading a game. I don't even know what game I'm leading, but I will give you bonus points for any of my classes that you are in. For any of my classes that you are in, if you come and hang out and play some games. Okay? It's a great chance to network. Another little announcement, if you do not have your classes set up for the spring semester, and I am your advisor, you need to check your email. But if I'm not your advisor, you need to talk to your advisor. You need to get your classes set up for spring because those classes are filling up quickly. Okay. Just double check and make sure you're good to go. All right. Some of you this doesn't apply to. Some of you already have done this, or you set them up last year. But if you haven't, you need to make an appointment with your advisor and get that done as soon as possible. Once those classes fill up, most professors won't go over the max in a class due to COVID restrictions and spacing requirements for classes. So do it, please. If I'm your advisor, check your email because I've sent you probably 3 or 4 at this point. All right. Is there anything else? Oh, there's no class on Friday. Don't forget that. It is homecoming / inauguration / fall break, all rolled into one neat little package. So participate in some homecoming festivities. It's going to be a busy weekend in Greenville. All right, we are going to continue on with our handout and finish going through chapter 4 today. We're going to try to get through all of chapter 4 today. Okay, mostly so that then next week we can talk about homework, we can have an in-class activity, and we can talk about your project and have it kind of be a little more of a chill week. Okay, so see how far we can get. We ended talking about how to take an adjusted trial balance and make our 3 financial statements. Okay, so that's where we were on Monday. I forgot what day it was for a second here. Now we're going to talk about the difference between permanent and temporary accounts. We're going to talk about closing accounts. Okay, so this is number 13 on your handout. I don't know exactly what page that is, but it's number 13. Accounts that are relatively permanent. I'm not muted. I'm not. Okay. Accounts that are relatively permanent from year to year. We call those either permanent accounts or real accounts. And what we mean by permanent is we don't try to zero out the balance in these particular accounts. Okay. The balances of these accounts are carried, I can't spell, and I say that every single day, are carried forward from year to year. So every year, we're going to roll these balances forward. There are specific accounts that we do this with, okay? Very specific ones. This is going to include all the accounts that are reported on the balance sheet. So if it's an asset, if it's a liability, or if it is the owner's capital account, it is considered a permanent account. When we started working on our project, we had that post-closing trial balance that we used to put the balances into the ledger. That post-closing trial balance is just showing us the permanent accounts that we have. On the other side of this, we have accounts that are permanent. We also have accounts that are temporary. So accounts that report amounts for only a specific period of time, or one period of time. I'm trying to remember the special name for these, besides temporary. We either call them temporary or nominal accounts. And they're not temporary in the sense that after we use them once or twice or for one accounting period, we're never going to use them again. The balance in that account is temporary. Okay. temporary accounts are not carried forward because they relate to only one accounting cycle or accounting period. I'll explain why in just a second. So if our permanent accounts are all of the accounts on our balance sheet, what are our temporary accounts? Where are they coming from? What's our other big financial statement? The income statement. So this is going to include all the accounts reported on the income statement and the owner's drawing account. Those are all considered temporary. And we're going to talk for a second about why they're temporary. We use the accounts in our income statement, and we use our income statement to figure out our net income, right? We want to figure out if we have a net income or if we have a net loss. And then we use that net income or net loss to figure out how much we're going to pay in taxes. If we don't close those accounts, if we don't zero out the balance in those accounts, over time, if we're super profitable, right, it's going to look like we have a ton of revenue and a disproportionate amount of expenses, okay? And because we pay net income or our income taxes on that net income is going to get bigger and bigger and bigger each year if we don't close those accounts. So we're going to pay a lot of extra money to the government that we don't need to pay if these aren't closed, because it's going to look like we made more money. We close them every single time, every single accounting cycle. There are specific journal entries we do to close accounts. They are called closing entries. So to report amounts for only one period, temporary accounts should have a zero balance. I spelled zero wrong, wow. I'll fix that in a second. At the beginning of the next period. So at the end of each accounting cycle, we are going to zero out the balance of our temporary accounts. The way that we're going to do this is we're going to transfer all those account balances somewhere else, okay? So we're going to transfer temporary account balances to permanent accounts through journal entries. We're going to do some specific closing journal entries to make this transfer happen. Okay. In part B, these entries are going to be called, as the name's already at the top here, are going to be called closing entries. Wow, I can't spell. So bad today. What's going on? And when we do this process, it might be something you've heard before, but it's called closing the books, okay? So this is called closing the books, or we just call it the closing process. I've heard both things. Companies do this sometimes every month, but if they're closing the books every month, they're not necessarily doing all of the closing entries. They're just getting to some financial statements every month. But all the books have to be closed every accounting cycle, which is usually a year, every year. Okay. All right. So again, know that this is repeating itself, but after the closing entries are posted, all temporary accounts have a 0 balance. That's what we're trying to get to. Okay. For this, there are 2 journal entries that we are going to do. With our first closing journal entry, we're going to close the revenue and expense accounts. There we go. And there's just a really easy step-by-step process we follow for this, okay? So when we close our revenue and expense accounts, when we try to get those to 0, all along we've been crediting our revenue account, okay? That's how we increase the revenue account. To close that, to make it have a 0 balance, we're going to debit. Debit each revenue account for its balance. So if the balance in the account is $5,000, we're going to debit revenue for $5,000. In that same journal entry, we are going to credit each expense account. Our expense accounts have a normal debit balance. So to give them a 0 balance, we'll do the opposite of that. We're going to credit them, okay? Now, if we debit our whole revenue and we credit all of our expenses, we're going to have an unequal journal entry, right? Because hopefully they're not equal to each other, and we don't really have a net income or net loss. So the difference between them, or our net income or our net loss, is going to be part of this journal entry too. So if we have net income, we're going to credit the net income. I don't know why I'm putting that in parentheses. We're going to credit the net income amount, or credit the net income, or debit the net loss. So if we have a net income, to make this journal entry equal, we're going to credit that amount in this journal entry. We have a net loss, to make this journal entry equal, we're going to debit that amount. So when you're doing your homework, if they give you a problem and it gives you all the revenue and the expenses and it doesn't tell you if there's net income or net loss, take your revenue, subtract all the expenses. The difference, if it's positive, is net income. If it's negative, is net loss, okay? For our second closing entry, we're going to close the drawing account. So we're going to close the owner's drawing account. We'll do an example of this in just a minute. Again, there's a very specific way that we do this one. So to close the owner's drawing account, it normally has a debit balance, right? So for the debit side of this equation, we're going to debit the capital account for the balance of the drawing account. So if the balance in the drawing account is $500,000, then that's what we're going to debit to capital. And then we're also going to credit the drawing account for that amount. Again, we're trying to get to that zero balance. I just realized something I forgot to tell you about the first one. When we credit net income or debit net loss, we don't have an account called net income or net loss, right? Instead, we're going to do that to our credit or our capital account. I'm going to use that. So I want you to think for a second about our income statement. We do our income statement to get to our net income or net loss, right? Yes, no? Everybody with me here? We do our net income, or we do our income statement to get to net income or net loss. When we have that net income or net loss, we take that and we put it in our statement of owner's equity. And we use that number in our drawing and any money the owners put in to figure out what our new capital amount is going to be. What we're doing on our financial statements is basically the same thing we're doing here. We're getting everything into the capital account. So we want everything to go, right? Because that account carries forward and these other ones don't. So what this looks like as a journal entry. We debit our revenue account. So we have fees earned and rent revenue. We credit all of our expenses, and at the very bottom, the difference that we had, or that we have, gets credited as well. Then we had a $4,000 drawing account balance, so we debit capital, credit drawing. What this looks like in the ledgers. For accounts that we don't close, except for capital, nothing really changes there, right? But then we get to our capital account. We have closing balances here. Now this closing should match what's on our balance sheet. And every other account after that should have a zero balance. Okay, so after we post them, all expenses, all revenue accounts, and the drawing account should all be zero. So we're going to do one of these together. This is going to be exactly like one of the problems that you're going to have on your homework. Okay? So we have accounts that have been adjusted on July 31st, the end of this company's fiscal year. The following balances are taken from the ledger of, that's quite a word, services company. So we have all these different balances. One thing I want you to realize is that they give you a number right off the bat that you do not need. It does not matter for this problem what is already in our capital account, okay? So the 615,000, ignore that number completely. We don't need it. So for our first journal entry to close accounts, we're going to put our date, July 31st. What are we going to debit for our first journal entry? Trying to close revenue and expenses. Which account are we going to debit? Fees earned. I'm going to debit fees earned for the amount that's there. So it's 300, I'm having trouble seeing that, 380,450. What are we going to credit first? Which accounts are we going to credit here for this first journal entry? We've debited revenue. We're going to credit. Yeah, expense, wage expense, right? We're going to do wage expense. We're going to do all the expense accounts. So we're going to have a credit for wages expense for $250,000. Except I put the wrong amount. We're just going to go down the line there. So wages expense, rent expense for 65,000. We'll have supplies expense for 18,250. Down too far. And then our miscellaneous expense for 6,200. So here it doesn't tell us the difference between them. We don't know the net income in this particular problem already. So to figure that out, I'm gonna take our handy dandy calculator and take our fees earned, so 380,450, and subtract all of our expenses. How much? 41,000. Thank you. I have to do all the math. So if the number is positive, that means we have more revenue than expenses. We need to credit that. That would be net income, so we're going to credit it. So we're going to use the owner's capital account, which here is Terry Lambert. So Terry Lambert capital for that 41,000. Now in real life, you would already know if you have net income or net loss, right? Because this is one of the last things we do. Okay. If we want to put a description here, the easiest one is just closing entry. Now we can do our other one. I'm going to scroll up just a teeny bit. So our drawing account is our other side of this. Our drawing account has a balance of $25,000. Okay. I think I left enough room. You can skip a line if you want to. On July 31st, do the second journal entry. For the second journal entry, are we going to debit capital or are we going to debit drawing? Which one? Capital. So Terry Lambert capital for 25,000. And then we're going to credit the drawing account. So again, just think through what's happening behind the scenes here. When we debit this amount to capital at 25,000, it decreases how much capital the owner has in the business. Just like when he takes that money out of the business, right? That decreases how much capital he has. So we're just putting everything into one nice, tiny, neat little package. Okay. Okay. And then again, if we want to put a description here, we can just put closing, not costing. Wow. Closing. There we go. Entry. Okay. Once we've done this journal entry and posted it, make sure we post it. It's an important part here. We have to do the post-closing trial balance. A long time ago, I told you there were 3 trial balances. There's an unadjusted, the one we did way back in chapter 2. There's an adjusted, the one we did in chapter 3. Now we have a post-closing one. The post-closing trial balance is prepared after the closing entries have been posted. I keep spelling closing wrong today. Closing. So after we do those closing entries, final trial balance. And again, the purpose of this is to verify that our debits equal our credits. It's the same purpose for every trial balance we do. We want to make sure our debits equal our credits. This one is going to be a lot shorter than the other ones we had. This is what one would look like. I'm not going to make you do it again because you've already done these. multiple times. All right, but all that's listed here now is our asset accounts, our liability accounts, and our owner's equity, our capital account. Okay. All right. 3 more things we're going to talk about in this chapter. We're going to try to cover them in the next 20 minutes. They're not very difficult concepts. Okay. The first is the accounting cycle. This is what we've been talking about since chapter 1. The accounting process starts with analyzing and doing journal entries, and it ends with the post-closing trial balance. This is called the accounting cycle. It's a cycle that we do over and over and over again. And there are 10 steps in the accounting cycle. We're going to list them as simply as possible, so you don't have to write just a ton. Okay? So the first one, we're going to analyze and record transactions in the journal. Yeah. There we go. Okay. So this is what we did in chapter number 2. We looked at those transactions, put them in a journal. For step number 2, what did we do after we put them in the journal? What was the next thing we did? Someone remember? There are journal entries. We also did this in chapter 2. We posted transactions to the ledger. So we analyze and record them in the journal. Then we post them in the ledger. After we post things in the ledger, I'm going to prepare the unadjusted trial balance. Steps 4 and 6 go together, and step 5 is the one that we've been skipping each time. So step number 4, we assemble and analyze there we go, adjustment data. I'm going to skip step 5 for just a second. We'll come back and get it. Step 6, we journalize and post adjusting entries. So these two kind of go with each other there. I'm going to come back to step 5 right now. Step 5 is that optional end of period spreadsheet. So we can prepare an optional end of period spreadsheet. This is also called a worksheet. Okay, this is the one I didn't have you guys do just because there's not a lot of point in doing them. And I just realized I didn't put a step 7 on here. So we're going to add step 7. My bad. Step 7, now we're going to prepare our adjusted trial balance. Okay, so 3 of these have to do with trial balances. Steps 8, 9, and 10 are what we've been doing in this chapter. So step number 8, we prepare financial statements. Step number 9, post Oh, sorry, journalize and post. Getting ahead of myself. Journalize and post closing entries. And step number 10, prepare a post-closing trial balance. You need to know these 10 steps. They will be on your final exam. So put a big star next to them, circle them, highlight them, whatever you want to do, you need to know them. Yes. So as long as you don't lose this, you should have it. Okay. You should know by now that accountants like to do things in steps. We have steps for everything. You would think we would get a reputation for being like, you know, nerds. We do. It's okay. Happily a nerd. Okay, last two things we need to talk about. The first one of those is the concept of a fiscal year. Okay, so the annual accounting period adopted by a business is known as its fiscal year. We're almost done. I know your hand's hurting. A lot of writing today. So a fiscal year does not have to start in January and end in December. A fiscal year begins with the first day of the month selected. We get to, as the business, we get to pick that. Pick the first day we want to. Oh, trying to highlight this, it's not working. And I think how we want to word this. And ends on the last day of the following 12th month. Okay. So what that means is we can have a fiscal year that starts on July 1st and ends on the last day of June. Okay. Yeah, I should say ends on. I'll come back and highlight that later before I throw it up on D2L. When a corporation adopts a fiscal year that ends when business activities have reached the lowest point in its operating cycle, this is called the natural business year. There are a lot of reasons, I should say natural. Wow. There are a lot of reasons not to use a calendar year as your natural business year, okay, or as your fiscal year. For example, when is Walmart really, really busy? What's their busiest season? From Black Friday to when? Christmas to January 1st. So if Walmart used a calendar year, all that time that they're super, super busy, they would also be trying to do all of their accounting closing process. And that's a lot. It is a lot of work to close a books for a company that big, right? So instead, their year ends at the end of February when they're not as busy. A company can do whatever fiscal year they want. Doesn't matter. You could have from September 1st to August 31st. You just have to declare it. That's what it is. It's that simple. Okay? All right. Last thing, our financial analysis for this chapter, we're going to learn 2 new formulas. Okay? We talked earlier in this chapter, chair's not moving, there we go. Talked earlier in this chapter about listing things on the balance sheet in order of liquidity. Okay? So the ability to convert assets into cash is called liquidity. That's what we're trying to do there. A concept that goes with liquidity is if we can pay our short-term debts. This is called solvency. We want to make sure our we have some assets that are liquid that we can turn into cash really quickly. We also want to be solvent. We want to be able to pay our debts. The two financial measures we're going to learn here are working capital and current ratio. We're going to use the same sets of numbers, just in different ways. Okay. Oh, it's supposed to be bold. Come on, don't do that. Our working capital is the excess of our current assets over our current liabilities. So the way that we're going to figure that out, our formula for that is going to be working capital equals current assets minus current liabilities. I'm going to put that on the next line. Okay. So the reason we split our assets and liabilities up is to figure out this equation. If our working capital is positive, if we have more assets than we do liabilities, that means that we can pay our debts / we're solvent. So I'm going to copy our formula. You don't have to keep rewriting the formula if you don't want to. But for example, if we have current assets of $7,745, current liabilities of $1,390, I'm going to do 7,745 minus 1,390. And our working capital is going to be 6,355. Which means after we pay off our current liabilities, we have an extra $6,355 in assets. Doesn't mean we have that much in cash, but we have that much in assets that we could turn to cash pretty quickly. The other side of this, the other way to look at this is something called the current ratio. It's another way we can express the relationship between our current assets and our current liabilities. And the way that we do this one, instead of current assets minus current liabilities, not plus, divided by current ratio is current assets divided by current liabilities. I'm going to abbreviate liabilities so it doesn't skip down a line. So same exact numbers that we just had. So now we're going to divide. So we have 7,745 divided by 1,390. And we're going to get 5.6. Okay. What that means is we can pay with the liabilities and assets we have, or the current liabilities and current assets we have, we can pay our debts 5.6 times. Okay. So it's a nice idea for that number to increase over time. All right. We're going to do this one more time with some different numbers. Get one more piece of practice in here. So for 2019, with the information we have, we're going to do working capital first. Working capital equals current assets. I'm going to start abbreviating. Minus current liabilities. So we have can't see the numbers. 310,500 minus 172,500. So our working capital should be about 138,000. We're also going to go ahead and do current ratio. Okay, so again, it's just the same numbers, and I'm just going to copy and paste them. Except now we're dividing. So when we divide those, we're going to get 1.80. Your homework will tell you how many decimal places to go to on this. Let's do this for 2018 too. Okay, so 2018. Oh man. We have working capital, so current assets minus current liabilities. We're gonna have 262,500 minus 150,000. Gonna give us 100, oh, not plus. It's gonna give us 112,000. They have to like look through the window and see that there's a class in here still. 112,500. And then our 2018 current ratio. Again, I'm rewriting the formula each time. If you do that, it helps you remember it eventually. Guys, wait. We have 310,500 divided by, oh no, I'm looking at the wrong thing. Thank you. 262,500 divided by 150,000. It'll be 1.75. That's the first part. Second part wants to know if the change from 2018 to 2019 is favorable. If this goes up from 2018 to 2019, that's a good thing. That means we can pay our debts more times, right? So it went up. This would be a favorable change. All right, some reminders. No class on Friday. We're going to go over your homework on Monday, so please at least have that started. I'll see you guys then.
Would like to correct my midterm exam.
It should have, I thought I put it in there. I'll double check and make sure I put it in there. But it's been graded. Your midterm's been graded. I haven't given them back yet though. I'm still waiting. Yeah, so if it's on D2L, you're good. I just haven't handed it back yet. Yes, yes, you're good.
In English, you want me to submit the grade of the project?
If you're done with it, that's you can submit it.
Yeah, because you read me in the 12.
Yeah. Yeah, so if you're done, just click submit. You're good.
And the homework.
If you're done, if you have 100%, submit it.
Thank you.
You're welcome.
My number 2, boy.